Emmet, Peppers, and Matt recently did an hour-long interview with Daniel Schreiber, Lemonade's CEO. And there was one really important thing that stood out to me from the interview that I hadn't before heard Daniel articulate so well. Lemonade pays for sales up front, but legacy insurance pays for sales forever. Let that sink in. Let the consequences of that statement sink in.
You let that sink in.
Lemonade pays for sales up front. Legacy insurance pays for sales forever. Okay, now think about that for a moment. Keep that in your mind. Now let's listen to Daniel's full comments.
So you bought a homeowner's policy. 98% of our homeowners policies are sold through Maya the bot or APIs with no human intervention, period. About 95% of policies in America for homeowners are sold through agents. It's like a mirror opposite.
Wow.
Yeah. So, and they take 15 to 20% of premiums in perpetuity, not just the first year that you paid, every year thereafter. Now, let's just take that as a talking point to highlight some of the differences between our model and theirs, because the differences run deep. And at first, our model looks worse. Why does our model look worse? Because we spent on CAC. We acquired you as a customer. So I don't know about you specifically, Matt, but we'll have paid Google so that when you did a search, our name will have appeared there. You'll have clicked on us, or however it is that we target you. So we've incurred all of the CAC upfront. We take a wham on the first year. And by the way, that same first year, your claims will be the highest, your churn will be the highest, you'll be your least attractive as a customer, and our cost structure will be at its highest. It's different for incumbents, because working through an agent means I don't pay a penny. I have no upfront expense. I share my proceeds with them in perpetuity. So now I have a partner siphoning off margin forever and a day, but my year one doesn't look different to my year two or my year three or my year 10. I've just got this drag on my earnings forever, but it's not front loaded. So I didn't take a cash hit. I didn't take an EBITDA hit in acquiring that customer. Now, if you're long-term in orientation, it's nice to take the hit once up front and then own the customer throughout their lifetime. But in the near term, particularly if you're growing fast, then a lot of your customers are first or second year customers. They haven't yet reached the I in the ROI. The R in the ROI. That you're doing loads of investment, but not yet return. If you stop growing, you see it very quickly. But if you want to keep growing, you're constantly adding more and more first-year customers, front-loading the expenses, spending on the CAC, taking the hit to the loss ratio. Year three, they're already looking like incredibly profitable customers, but by then you've stacked on a lot more customers. So once you understand those dynamics, and if you're a long-term business builder or investor, then you say, oh, I'll definitely invest $1 now to get back $3 later, and I don't mind that it will appear upside down on the economics. And by the way, pile on loads of those, because even if it creates a negative EBITDA today, I understand how that plays out over time, and you're just compounding my returns, so bring it. But it looks very different to a traditional insurance company, agent-based, with the cash flow looking better and just the margins looking abominable further down the path.
The structure of insurance brokers and their commission is insane. Insane. As Daniel said, most insurers use agents or brokers, and brokers, they take anywhere from 10 to 15% of premiums forever. And I've checked into this, and it's true. Typical commissions in Canada range from 10 to 12% for auto and 15 to 20% for home. This is about as stupid as financial investors taking a set percentage of your entire portfolio amount, no matter how well or not well they invest your money. But I think it's even more ridiculous with insurance agents, because insurance agents are just selling you a product. Purely a salesperson. They're not actually, on top of that, they're not doing anything or performing in any way beyond that. So just think about this for a moment. I mean, what value does your insurance agent or broker provide you? I mean, you could make the argument for some niche insurance products. Maybe they help answer some obscure or confusing questions, or give clarity on coverages, etc., and some things like that. Some sort of information distribution points and answering questions. But beyond that, what value do they add to the value stream of the insurance product? Very, very little value, I would say, and certainly not worth 10 to 20%. 10 to 20% of the entire premium amount. Insane. Meanwhile, Lemonade does pay more for their own customer acquisition up front, which makes their upfront costs higher and their unit economics up front seem maybe a little bit worse, but then that's it. Imagine the alternative if somebody pays, say, $2,000 a year for home insurance for 10 years, say. And a 20% commission, that's $4,000 over 10 years. Imagine that customer who used your product for 10 years' time would have a $4,000 sort of customer acquisition cost over a 10-year period. And then those costs, even if that customer kept going, would of course continue occurring over time. Meanwhile, Lemonade pays once and is done. And Lemonade can onboard people early in life and determine who the best customers are, and then really target and give bundling discounts to the very best of those customers, the lowest risk profile of those customers, the customers who make it through their first, second, third, fourth, fifth years and have no claims and no concerns of having claims in the future. And the thing about Lemonade's strategy is that it will look worse as they scale. But if you can recognize this as investors and see profitability coming before the market does, then I believe there are huge possible returns to be made. Massive. I'm modeling peak losses occurring this quarter or right around this quarter as per guidance, and then Lemonade reaching profitability in 2025, near the end of 2025. And then from there, I see them funneling all of their cash flow into growth, which funnels into a better and better product and creates a better and better product for the best and lowest risk customers. And of course, could mean massive returns for investors. The insurance broker commission is just one piece of the thesis for Lemonade, but it's a huge piece and a massive way that Lemonade can save on expenses long term, thus making customers happier and keeping the lowest risk customers to stick around, and also ultimately keeping shareholders happy with massive possible returns. These are my thoughts. If you want to see this entire model, you can get that by joining my Patreon. Let me know in the comments what you think. I read all of your comments, appreciate your feedback, and remember, it's in the bag.